What is up guys, Taiki here, and hope everyone's holding up well. With my channel, I kind of wanted to focus more on making evergreen content, especially in a bear market, right? There's like less people around, less people care about crypto. So if I'm going to spend many hours making these videos, I want to make videos that people will watch not only now, but also in the future. And technically I don't run ads, so I shouldn't care, but like I said, if I'm going to spend time on this of my free time, then, I want to make videos that people watch. And GMX and GLP our protocol or like our products that I've talked about a lot in the past, but I kind of wanted to make one long form video that people can refer to if they want to help educate their friend about GMX. And if you're a new user to GMX, or you kind of heard about GMX GLP and you want to understand the risks and the benefits of using it, then this video is for you. Okay. And obviously my knowledge is constantly evolving. One thing I will say about GMX is that their documentation isn't that great. I don't think it's been updated for quite some time now. And one benefit that I have as a YouTuber, I guess, is that teams actually want to talk to me. And I have a direct line of communication with the team. So there's a bunch of, frequently asked questions. Hopefully I can address them here. And I have screenshots from the team that, they've given approval for me to share. So hopefully this video is useful. Full disclosure, not financial advice, right? I have no idea what I'm talking about, right? I'm just some random dude on the internet. I do have a small GMX position, and I've been farming GLP for quite some time now. So maybe you can say I'm biased, but you can also say that I have experience using these protocols. I've risked my own personal capital, right? Quite a significant amount. So not GMX, but in the form of GLP. So I've had to force myself to understand the risks because I'm not gonna randomly YOLO my hard-earned money into things that I don't fully understand. Here's the agenda, and like I said, the goal of this video is to watch it out, right? Watch it throughout, and you can understand the benefits, like the bull and bear case, farming strategies available to you, and yeah, the risks, right? Because we always have to think about the risks. So let's first go over the product and what is GMX. It's a decentralized spot and perpetual exchange that supports low swap fees and very low price impact rates. It's currently on Avalanche and Arbitrum. These two L1s, they've mentioned plans to expand horizontally in terms of other L1s, but their main priority right now is to just build out their product on these two chains, just focus on the product itself, retain and acquire new users, which they have been doing, which is pretty impressive, especially in this type of market. And yeah, so let's keep going. So this is the UI. You can do up to 30x leverage. I think you can do up to 50x leverage depending on the asset, I believe. I don't really trade. I'm just like more farming this. But you can long, short, and you can do spot swaps between Avalanche, ETH to USDC, etc. Right? Okay, and this is the volume and the fee. Sorry, the logo is blocking up fees, but volume and the fees. Obviously, the pink line is up only because it's a cumulative line. But I expected this trend to go down in the bear, just because there's less people interested in crypto. But surprisingly, the volume and the fees and the amount of users using the platform has actually been flat, right? And flat is good in this type of market, and in some instances up. So on the left you see unique users, right? And on the right you see new users. And this is on Avalanche's side. GMX has been has been around longer on Arbitrum, and as you can see, there's like more data and just bigger nominal numbers, just because it's been around longer. And you can see the volume and the fees there, and unique users and new users, right? I would interpret this to be bullish, maybe not bullish, but not bearish in a bear market, which you can argue to be bullish, right? But okay, let's talk about partners and integrations. And for most projects, most DeFi protocols, like partners, it's like a buzzword, right? Oh, like we partnered with Nike to do XYZ, right? But when it comes to GMX, these partners and integrations are actually value additive to the protocol. So there's two main partnerships, one with DEX aggregators and one with KeeperDAO. So DEX aggregators like Paraswap, 1inch, and Yak, they've integrated GMX. So if someone goes to Paraswap and wants to trade USDC to Bitcoin with size, right? Wrap Bitcoin, the DEX aggregators will check all the DEXs, figure out what the most liquid, right? The most low slippage and low fee swap is, and it'll route the trades that way. And though there aren't that many people actually going to gmx.io and making these swaps, if people are using these DEX aggregators, it actually trades and routes a lot of trades through GMX just because it's so liquid. So, this is just a screenshot of the past. I mean, this is a month ago, but the brown line right after the integration with 1inch, a bunch of trades were routed through GLP, through 1inch, And this is good for the protocol because more fees means more revenues, and more fees means that if you're farming this via GLP, higher APRs, and you're not being paid out in the farm token, you're actually being paid out in ETH and or AVX, depending on the chain that you're in. And the second partnership integration that I talked about is KeeperDAO. I talked about KeeperDAO in the past. They focus more on MEV using keepers and whatnot. And the partnership, the partnership that they have is pretty interesting because one of the problems that AMMs and DEXs have is just bots and front running. And because GLP doesn't have impermanent loss, there's no automatic rebalancing of these pools. There were a lot of bots that were extracting value from GLP and just keeping it in their pockets. But with the KeeperDAO partnership, keepers from KeeperDAO are now able to, front run, bots in the wild. And, obviously these keepers, these MEV bots, these arbitrage bots will keep a part of the revenue. But previously, all the revenue went, all the arbitrage and the fees went to the bots, right? They made the money. But through the integration with KeeperDAO, 80% of the arbitrage revenue actually goes to GLP and GMX stakers, right? So it stays within the protocol, and 20% goes to these keeper bots. So though the moderator said, or though the team member said that this shouldn't create too much additional fee revenue in the overall grand scheme of things, but it's something, it's a very thoughtful partnership that leads you to believe that, okay, the team knows what they're doing, and they're going to keep working with other protocols to create more value for GLP and GMX holders and stakers. And GMX and GLP has gone a lot of buzz on crypto Twitter and the whole DeFi community because of GLP and the farming opportunities that it provides. And for the system, like how the system functions is, of course, it's an exchange, right? It's a spot exchange and a perpetual exchange. So there has to be liquidity. There has to be, for there to be liquidity, there needs to be an incentive to be a liquidity provider. And for there to be traders to actually generate volume and fees on the platform, there needs to be sufficient and deep liquidity to allow for low slippage trades. And if they can, balance these two incentives out, right, both from the LPs and the traders perspective, and without, diluting token holders, then that could be some tokenomic model that actually is sustainable. And so far, though it's not proven, it's kind of proven, but it hasn't been around for that long. So far, it hasn't been sustainable. More liquidity, more trades, more fees, more liquidity. And most farms, when there's more liquidity, it kind of dilutes the yield, right? But I think when it comes to DEXs and perpetual exchanges, if there's more liquidity, sure. If the amount of trading is so if the amount of liquidity doubles and the amount of trading volume is flat, then yes, technically the yields are diluted by 50%, right? But when it comes to perpetual exchanges, if there's more liquidity, then technically there should create more incentives for larger players to trade, which should generate more fees. And you can kind of see where I'm going with this, right? There's a future to this, right? Is this guaranteed to work? No. But is there a future, right? Can I see a future where this thing does work? Yes. So I think it's important to focus on these protocols, especially in this type of market. So let's talk about GLP, right? And this is the incentive for liquidity providers to risk their own capital on GMX. GLP is a basket of currencies that you can buy and provide liquidity for, so traders can use your liquidity to trade, right? So when you buy GLP, you're essentially being a counterparty to traders, right? You're being a liquidity provider. And on Avalanche's side, this is the basket of GLP, and the target weight of GLP is 12.5% Avalanche, 12.5% Ethereum, 25% Bitcoin, and 50% stables. And the team dynamically adjusts this depending on market volatility. So I think a month ago, I think it was like 15% Avalanche, 15% Bitcoin, 20% Ether. But because the markets are so volatile, GLP is more heavily weighted towards Bitcoin, which I don't mind, to be honest. And right now, at the time of screenshot, the stablecoin percentage is 63% roughly. So there isn't automatic rebalancing, right, to get it back to 25%, especially for Bitcoin. But there are dynamic fees that not automatically, but use natural market forces and incentives to get it back to the target weight. And I'll kind of go over how that works. Yeah, so when you're buying GLP, theoretically, you're buying this basket of currencies, but it's never perfect, right? There's always volatility and there's always variance when it comes to buying GLP. And there's no impermanent loss in GLP. And for example, right now the system is underweight avalanche by roughly 6%. So how the system tries to get more avalanche into the pool is via dynamic fees. So obviously the system is lacking, or GLP is lacking avalanche, so the system wants more avalanche. So if anyone, right, in the open market wants to sell avalanche and wants to, let's say, sell avalanche into USDC, then the system will charge less fees to sell avalanche into USDC. Therefore, these integrations with DEX aggregators, because it's on avalanche, the fees are lower than Trader Joe, for example, it'll automatically route these trades through GLP and it'll try to rebalance the system in that way. So that's kind of how it works, right? And similarly, if the system is overweight USDC, then there's going to be more incentive to take out USDC from GLP, right? Dynamic fees. And GLP has been an amazing way to DCA into the markets because, this basket of currencies, maybe you're less bullish avalanche, maybe you only believe in Ether and Bitcoin and whatnot, but if you look at the farming rewards that this is giving you, even if you don't like avalanche, I still think that, me personally, I feel comfortable deploying this capital just because the farming rewards are pretty attractive. And obviously on Arbitrum, the basket is different, but instead of focusing on like avalanche and Arbitrum, saying the same thing over again, I'm just going to focus on just the avalanche GLP, right? It's also a great way to hedge your portfolio. I'll go over hedging strategies later. And also, because you're being a liquidity provider and because there's volume and fees being generated by the platform, it's earning fees. And those fees are paid out in the form of avalanche or ETH, depending on the chain that you're in. And these fees are organic, right? So more fees means more farming APRs. And that's one of the reasons why everyone has liked farming on GLP, because you're actually farming something that you want to hold, right? Maybe you want to dump AVAX, maybe you want to dump ETH because you think it's going lower, but the optionality to earn these rewards and these actually desirable tokens, I think is pretty valuable. So so this is a fee. So if you buy GLP, you're being a liquidity provider and you earn roughly 32% paid in Avalanche and 7% paid in escrow GMX. And I'll kind of go over how that works later. And the team targets a 35% APR for GLP. So if for whatever reason fees are low on a particular week, and let's say the Avalanche APR for next week is like 27%, right? Then because the target weight is 35%, or the target APR is 35%, the team will say, okay, 35 minus 27 is 8, so the escrow GMX APR is going to be 8%. So that's kind of how the system works. It's never going to be perfectly 35%, but that's kind of what they're going for. And and the APRs are updated every Wednesday. So if the fees are updating every single day, then there's going to be so much volatility in the form of fees. So what the system does is it collects fees from Tuesday to Wednesday, and then for next week, it'll take all those fees and uniformly distribute it over that week. Okay, so whatever fees you're earning now is fees generated by the platform the week prior. Okay, and that's kind of what he's going for at KR. Rewards are paid from the previous week's fees. It's done to help keep the distribution smooth. Then the rewards unlock every block. Every week, the fees are collected and added to the distribution contract and sent out again. So it's more of a smooth distribution, even if the fees are going up and down in any particular day. Yeah. And I'm not going to go over this, but essentially when you provide liquidity for GLP, the APR that you're receiving in the form of Avalanche, it comes from swap fees, funding rates, minting fees, burn fees whenever you mint or burn GLP. And whenever a trader loses money, so let's say markets is going up, a degen levers long and the market dumps, and the degen traders loses $1,000. Then that $1,000 is distributed uniformly across GLP holders. And if a bunch of traders lose on a particular day, then GLP traders are winning, right? So when you're, like I said, you're a counterparty to traders. So when you're a GLP provider, you hope traders lose, because when traders lose, you actually make money. That's how it works. Yeah. When traders win, money comes out of you, right? GLP. Traders lose, their losses get added to GLP. So you're essentially being the house. And there's always concerns about, okay, what if, yes, traders always lose money historically, but what if like Bill Gates comes in, like levers long his net worth, Avalanche, and he's correct, right? And he drains the pool, right? Like there's always those concerns. And, obviously, I think people should consider this tail risk. because it's really, really difficult to quantify, right? Actually, it's impossible to quantify. What are the odds that, you know, traders lose money, win money on a particular week? We can look at historical data, but there's always tail risks. KR, right, actually mentions that the biggest risk to the system is when traders are shorting the market and the market is nuking like really, really hard, right? Because if the markets are pumping and, you know, traders are longing, right, and they extract some value from GLP holders, it's not catastrophic to the protocol because the value of GLP is holding up and the system is functioning properly. But if the markets are going down and traders are shorting and they're, you know, extracting value from GLP, that presents a risk because not only is the basket of GLP, the basket of currencies within GLP is going down, but also traders are extracting money from GLP providers, which could incentivize people to not want to hold GLP. And if there's like a run on, you know, people rushing to get out of GLP, then perhaps the system is less favorable, right? Because, you know, for there to be trades and for there to be leverage trades, there needs to be liquidity. But the system mitigates that by limiting the amount of shorts that are able to be opened up. And I wasn't able to get like the actual number, right? So like what percent of open interest can be short, what percent of TVL, GLP TVL can be actually short, right? So, you know, if GLP TVL is 50 million, then is the max short open interest, can that be like 20 million, right? So I don't really know the exact numbers on there, but this is like the biggest risk to GLP is when traders are shorting and markets are nuking. And you know, quite recently, when the markets were nuking, you know, I saw on the platform that the open interest for shorts were roughly 10 million and the long interest was roughly 2.5 million. And I was kind of spooked at the time because I was like, okay, like this is one of the risks. You know, I'm monitoring this because I have some capital into this. I'm going to just get out, wait for the open interest to even out and then get back in, right? It kind of made sense to me at the time. And also because of the uncertainty, I was like, okay, like it's okay. Like I'm fine sacrificing EV in the short term if it can mean that I get some rest. So that's what I did. And you know, after the fact, right, the next morning, I was like, okay, like, did that actually make sense? I asked KR and like, am I overthinking this, right? Like, am I just trying to like time markets and I'm like losing a bunch in fees? And I think KR made a pretty good point that yes, like in the past couple of weeks, the markets have been downtrending and it's been scary. But if you look at the historical long short interest, at least the open interest, traders tend to skew on the long side because I think, you know, that's how psychology works. People would rather like buy things, right? Instead of like shorting things. And, you know, in his opinion, ETH and Bitcoin dropping 60 to 80% from the highs and GLP maintaining and growing in TVL is probably a good sign that the system is pretty battle tested and there's less concerns about, you know, people shorting and making money. And, you know, it's kind of weird because technically when the markets are nuking, when there is peak fear, that's when you should want to buy, right? Historically. But there's some conflict of interest because, you know, when numbers are red, when there's peak fear, then short interest balloons on GMX. So maybe it's less attractive to knife catch via GLP, but I think, you know, if you look at the historical trader data, yeah, I think I have it here, right? Traders are like losing money on average. So yes, you know, on any particular day, there could be one day where like traders just extract so much money from the protocol. But on average, you know, traders are just getting wrecked, both on Avalanche and Arbitrum. And, you know, this is, if you just Google like what percent of traders like make money, it's like less than 10%, right? So I feel like generally being the house of the GMX casino, probably a good idea, right? But there are tail risks and you have to be aware of those risks and, you know, enter GLP because of course the yields are so high because there are like risks, right? That is very, very hard to quantify. So yeah, like I said, there are tail risks because smart contract and traders extracting value. But essentially, you know, being the house of casino, generally a good idea, right? I mean, I come from a poker background and, you know, the house always wins, right? The house always wins, as you can see. But, you know, it's possible you do underperform the basket since traders can win in any short time span. But, you know, data suggests that it's very unlikely in the long run, right? In the long run, traders should lose money. Let's go over the team and their risks surrounding them because the team is completely anonymous. And I completely understand, right? I completely understand if you're a developer and you're trying to build in DeFi, you know, there's not too much upside in like being doxxed aside from being able to meet people, network, and I guess raise money and whatnot. And I've been fairly wary of anonymous teams in the bear market because, if you look at projects that are hard rugging or soft rugging, they are anonymous teams with tokens that are nuking to zero. And at some point, if the TVL of a protocol is like 10 million and the token is going to zero, then there's no incentive for the team to work on that project. So they might just rug, take your money or just abandon the project. If they abandon the project, then, your capital isn't at risk technically, but it's a scary risk. But the team does have a pretty strong track record. The community is super strong. If you join the Discord, the community is pretty strong. But I don't really know the team. I asked to talk to KR, the mod, but he said, yeah, I don't want to dox my voice. So the team seems to be very, very careful when it comes to building out their product and being completely anonymous, which I completely understand. But as a user, as a market participant, it is a risk. They were audited by a firm that audited UniV3, ABDK Consulting. So maybe that's a vote of confidence. And I asked hey, this audit is pretty outdated. When are you going to get a new audit? And they mentioned that, they're looking to build a new protocol upgrade called X4. And they'd rather get an audit after they ship that product, which makes sense, but you never know, right? You never know. And talking about the team Runway, right? And like I said, right? Generally avoid teams and projects that don't have money, right? Because what are their incentives for working? And recently, or I guess not recently, but at the beginning of the year, GMX raised around, not around, but essentially they sold some of their team tokens and escrowed vested tokens to raise cash to raise some runway. And X10, who is the main dev for GMX, they mentioned that they sold 50,000 escrow GMX in March for roughly 1.5 million, which should last the team until the end of the year at least. So it's currently June, so maybe that's not too comforting, right? Maybe it's not too comforting. I read somewhere that they actually have over a year worth of runway, so they have enough money to last them, until June of 2023 and whatnot. But like I said, I couldn't really find it again. I forgot where I read that information, so there's that risk, right? But I feel like they're continuing to ship, so I'm more optimistic than pessimistic, to be honest. They have 4 full-time devs, 4 biz dev marketing teams, pretty lean team. So maybe the 1.5 million can sustain them for hopefully quite some time. Okay. Yeah, I heard rumblings that they have over a year with runway, but something to note. Let's go over the tokenomics, because the tokenomics is why this protocol is interesting. So out of the fees that are generated via spot swaps and leverage trading, 70% of the fees go to GLP holders and 30% of the fees go to GMX stakers. Okay, that kind of makes sense. And I'm a fan of GMX and GLP tokenomics because it aligns the incentives of stakers, minters, or liquidity providers and traders on the platform. For there to be liquidity providers, right, for people to take on that risk, there needs to be sufficient incentive. And other protocols, right, projects that go to zero, those incentives are paid out in the farm token, right? But with GMX, the fees are actually organic and it's being paid out in Avalanche indeed, right? That's actually sustainable. And for traders, their incentive is having a liquid exchange that they can trade on, right? And also the decentralized aspect where they don't have to KYC. So, GLP and traders, those incentives align. And also if you're holding GMX, if you're farming GMX, if you're staking GMX, then you're also benefiting because 30% of the fees do go to GMX stakers. Okay, so the incentives of GMX stakers, incentives of GLP holders, incentives of traders, they all align. The revenue sources are sustainable, so clearly there's a future, hopefully, if they can keep building on the platform. So yeah, let's talk about the escrow GMX. I mentioned this before, but how does this actually work? So escrowed GMX tokens are vested tokens, and you can only convert them to GMX, and they vest over 365 days. So the simpler way to understand it is if you want to farm GMX, you need to farm escrowed GMX and then manually take your escrow GMX, vest it, and then it'll linearly unlock for 365 days. And if you want to vest your escrow GMX, you need to keep your liquidity staked on the platform. So if you farm it and then you take out your liquidity, then you can't vest your escrow GMX. It incentivizes staking your liquidity, right? I've been doing this for many months. It's slowly dripping, right? It's pretty slow. I'm not gonna lie, it's pretty slow because not only do you have to farm it first, farm escrow GMX, and then you have to vest it, right? So there's like 2 steps. So it takes a long time, right, for these things to vest. But from the tokenomics perspective, it means that the circulating supply is growing at a less rapid rate, and people that are farming it are people that are more comfortable and, I guess, providing liquidity for a longer period of time, right? So that's how the system works and sustains itself. There's also this concept of multiplier points, and this applies to GMX staking. So it's sort of like VEPTP, right? A VE platypus. But if you're not aware of that, then essentially the longer you stake, the more multiplier points you receive, and the more multiplier points you have, the more fees you get to earn. And once you unstake your GMX for escrow GMX, you lose the points. So it incentivizes people to stay within the ecosystem. Okay, using tokenomics using tokens to incentivize human behavior. That's kind of how crypto is supposed to work. And the multiplier points only apply to GMX yields. So if you have GLP and you stake your GMX escrow GMX, your GLP yields do not get boosted. The only yields that get boosted are your GMX staking rewards. Okay, so these ones, right? Oh, sorry, not these ones. I think I have a screenshot. Yeah, oh yeah, these ones. Okay, so I've staked long enough where I have like roughly a 25% boost, and the GMX price obviously has gone down with the rest of crypto, but it's actually held up pretty well. Right now, the APR I'm earning on Avalanche is 31%, and part of that is being boosted, right? Okay, cool. And let's talk about some strategies, farming strategies, because this is a DeFi/yield farming channel, and it's a good farm. It's a very, very good farm, right? So being an LP on GMX pays you handsomely in Avalanche and ETH rewards, while also logging a basket of assets that you might be bullish on. So half of the basket, right, half of GLP is Avalanche, Bitcoin, and Ether. Half of it is stablecoins. Obviously, a little bit different on Arbitrum. And I was kind of doing some math, right? Because, okay, if I want to DeFi into the markets, maybe I use GLP. But if I'm bullish to markets, then is it better to expose myself to tricrypto, right? Because tricrypto is a product on Curve where it's, instead of GLP, where it's 50-50, tricrypto is 33% ETH, 33% Bitcoin, and 33% stablecoins with impermanent loss. So I'll be doing the math on what happens, right? Comparing the results of GLP and tricrypto if the markets go down or the markets go up. So let's get to the calculator. Okay, so this might be a little bit confusing, but I'll go over each section one by one. So the first section here, right, the top left, is Avalanche GLP. And these are the weightings that you're familiar with. This is GLP on Arbitrum. Okay, these are the current weightings. And this is tricrypto weightings, right? 33% of Bitcoin, Ether, and stablecoins. I took the highest price of May 25th, just random date, and I got these figures, and I inputted the current price of these two assets, right? Or all these assets. So Avalanche is down 43%, Bitcoin down 33%, ETH down 47%, Uni's down 10%, Link too, which is kind of interesting, right? But anyways, let's keep going. And I went through all this and I kind of calculated, okay, assuming that the weighting is consistent, which isn't realistic, but just making assumptions here. When this happened, right, and you bought GLP at the top of May 25th, you're down 19.44% on Avalanche. Though, Bitcoin was down 33%, ETH was down 47%, but you were only down 20% roughly. So, I guess, because the basket's like half stablecoins, you outperform in that sense. On Arbitrum, right, if you bought the top of GLP, I guess, on the 25th, then you're down 19%, right, roughly, which is pretty good. And on tricrypto, you're down a little more, 27%, just because, with GLP, you're roughly 50% stablecoins, and tricrypto, you're roughly 33% stablecoins. So this is what happens when you buy GLP and the market goes down, okay? And this doesn't take into account the fees that you've been earning. So if this happened over the course of a couple of weeks, then sure, you might be down, but you're also earning a bunch of fees. But if the market were flat, you would just make a bunch of money earning fees. And if the markets are going up, then you would also earn fees. So yes, this is what happens. Of course, GLP outperforms tricrypto on the way down, and Bitcoin and ETH. But what happens if price goes up? So let's kind of reverse this. So let's take the current price, put it in the here, right? June 22nd. And these are random numbers, right? I just pulled them out of my butthole. If Avalanche goes to $30, it's up 26%. Bitcoin, same exercise, right? The numbers are pretty consistent. And in that case, Bitcoin would go up a lot, right? 58%, ETH 57%, but GLP would only go up 31%, right? You underperform on the upside, but you outperform on the downside. Tricrypto, because it holds less stable coins, also goes up this particular amount, 39%. And in this example, I mean, this is a simulation. It's not going to be perfect. This also doesn't take into account impermanent loss with tricrypto. So there's always variance there, but it's just to give you a overall understanding of, okay, if the markets nuke, better off in GLP. If the markets are flat, better off in GLP. If the markets go up, then I should have just bought a bunch of Bitcoin or Ether or Avalanche or whatever altcoin. But you don't know the future, right? But the point is, you don't have to know the future. You just have to make educated bets, make plus EV bets, and earn yield along the way. And as long as you're not making dumb decisions, then you should be making money over a long enough period of time, assuming that crypto isn't dead, right? DeFi isn't dead, okay? So that's like there's just buying GLP strategies, what happens on the way up and on the way down. But what about the hedging strategies that I mentioned before? And hedging is synonymous with like shorting. But I focus a lot on money market strategies on my channel because I am I am on chain. I use DeFi. I farm on DeFi. And one thing you can do is you can deposit collateral on Aave, which is a money market. It's a bank, and you can borrow Bitcoin, ETH, or AVAX, and then taking your borrowed funds, you can buy GLP. So essentially, let's say you take $10,000 with the AVAX and you buy GLP. So you're selling half of your AVAX into stablecoins, and you're also selling 12.5% of your AVAX into ETH and 25% of your AVAX into Bitcoin, right? So you're essentially taking a volatile asset, you're shorting it to long a volatility muted asset, which is GLP, which is also earning yield, right? Because this is the target weight of GLP. So let's do two examples again of, let's say you short AVAX and the market pumps. This means you lose money, but obviously you don't know the future. And if you want to hedge your portfolio while also earning yield, maybe this is a good solution for you. So I made this calculator like a month ago, and the weights were like this. It was a little bit different. So the numbers aren't perfect, but I'm just using the same screenshots just for simplicity, and the overall message is the same, right? If the market goes up, then yeah, you lose some money because you're hedged, but maybe in the overall construction of your portfolio, that's fine. And if the market goes down, then you make money. And that's kind of the point you're going for. So let's say you short $10,000 into GLP, and GLP goes up, and you're longing it. So you're shorting Avalanche, an example. And obviously, if you buy $10,000 with a GLP, depending no matter like what asset you're shorting, the values, assuming that these allocations are the same, is going to be worth this much, right? But because you borrowed AVAX and you sold it into this, which is now worth 11.5K, and Avalanche went up 40%, you now owe $14,000 in debt. So you lose $2,500 on this particular short, okay? Which is expected, but yeah, like I said, depending on how you're managing your portfolio, maybe that's fine. But what if you short Avalanche and the market dumps, right? Same math here. If these numbers go down by 10, 20, 25%, then the value of GLP is $9,075, right? Just doing simple math. And yeah, assuming, like there's no impermanent loss, assuming that the pool remains balanced, you actually make $1,500 because you borrowed $10,000 worth of Avalanche, and Avalanche went down 25%. So now you only owe $7,500, but your asset, right, is worth $9,000. So if you want to pay off your debt, you make that much. And you can keep this in Avalanche, Bitcoin, ETH, stablecoins, whatever. So that's one thing you can do. And depending on how long this takes, you're earning yield, right? You're earning Avalanche, or you're earning ETH, and you're also earning esGMX, you're investing GMX. And if if GMX is interesting to you as an asset, then maybe this is quite an attractive way to buy the dip, knife catch, or short hedge, yeah, your portfolio. Cool, and this is like the overview, okay? Yeah, so hedging with upside, hedging with GLP, lower upside, but hedging for downside in your portfolio. You also earn historically amazing yields in esGMX. So I'm happy either way, right? If I'm like gig along in other aspects of the portfolio and I want to just hedge with like 20% of my portfolio or something, right? I can just do this and be happy either way, or maybe not happy, but just be more comfortable that way to maximize your sleep adjusted returns. Cool. There's also this thing called the GMX Blueberry Club. I'm not going to spend too much time on this, but this is only on Arbitrum, but there's this 10,000 NFT collectible thing. These are these cute blueberries. I own one. The floor is like 0.25 ETH, and the treasury. I think part of the fees. I think they take like a 5% royalty or something. Part of that goes to the treasury, and whatever fees that they earn goes into GLP, and it helps fund the team. I don't really think it's gonna have too much value, but it's kind of a cute way to I guess be part of the community. And if you're on Twitter, you're gonna encounter a bunch of these blueberries, and that there are GMX or GLP maxis. And the treasury right now is like roughly $660,000, so not too bad, right? It's a way for the team to raise cash, build a community, and also incorporate some value added for the community. And I don't know if this is still happening, but there was like a monthly escrow GMX airdrop. So 5,000 escrow GMX goes to the 10,000 entity holders. So that I guess it's a token, or it's an NFT with some utility, right? So I don't really know what the bull case is aside from GMX becoming big and the Maxi community becomes super strong. But there's that. So summary. I think GMX is a great platform that's growing in daily active users and trading volume. GMX stakers earn fees, and traders benefit from a more liquid pool to trade from, right? It's all mutually beneficial protocol that makes sense economically using token economics. With the ability to short assets on Aave and also, buying dips and whatnot, I think it's a good way to hedge your assets, hedge your portfolio, and also a way to gain exposure to a volatility muted basket of currencies, while also earning yield, which I think is very attractive in this type of market condition. Let's go over the investment thesis, and props to Riley GMI on Twitter but I'll link this in the description, but he wrote like this 55-page paper in February going over his thesis, so it's a little outdated, but the community is like writing these theses, right? These long form theses, so it's pretty interesting. But in 2021, perp volume in the digital asset space was 57 trillion, accounting for 53% of all trading volume. And though the decentralized, the DeFi perp, most swaps happen on centralized exchanges. Roughly 2% of the market share in September 2021 is now 5.4% in November 2021. I don't know what the number is today, but if there is demand for decentralized perpetuals, and if you expect more trading volume to occur in crypto, right? If there's more speculation in crypto, then if GMX can take some market share away from centralized exchanges, DYDX, for example, then you can make a bull case that yes, volume and fees will continue to grow, amount of users will continue to grow, and that's going to provide more utility for GLP stakers and also GMX stakers, right? Token value accrual. In terms of supply, the total supply of GMX is 13.25 million coins. Of course, most of them, maybe not most, but some of them are going to token emissions. And obviously with that whole escrow GMX vesting system, it's likely that not all GMX will ever hit supply, right? So even though I'm aggressively farming, GMX and whatnot, it's very unlikely for me to actually realize all those tokens because it's just gonna be very, very hard. So it's quite likely that the actual total supply is gonna be lower than this. And because of the whole token economic system where, you can only farm GMX if you're a longer term actor, the tokens are going to stronger hands, right? Of course, there's going to be a price where I sell, right? There's always a price. But, theoretically, it's going to stronger hands, and the tokens are going to people that actually believe in the system, which you can argue to be a less cannibalistic token economic design. And I guess, tokens are going to stronger hands, I guess, right? And demand for GMX. So it's a governance token. It's the governance aspect is like not there yet, right? Like no governance token is like fully decentralized, but maybe it gets there. But even if you don't care about governance, if you see volume and fees go up, the amount of users go up, then you can stake your GMX and earn 30% of the protocol revenues. So most governance tokens like Uniswap, things like that, yes, the protocol makes a lot of money, but there's no way for the value to go to token holders. But with GMX, is the security kind of, yeah, but it's kind of a security, but there's a way for you to speculate on the future success of the protocol, which I think makes sense as an investment thesis. Like I said, I don't know what I'm talking about. I'm literally screenshotting, pages from Riley GMI. So, thank you, Riley. But, just sharing the research. Yeah, GMX earns fees from spot trades and perpetuals and leverage trading. Its success relies on growing its pie in the decentralized perp market space, which is pretty large. And in terms of competitive analysis, I think DYDX is currently number one. I don't know if you can see this, but this is DYDX. I think DYDX is number one in terms of volume, and GMX is number two. And perp is on Optimism, and injected protocols on Cosmos, but there's not that many people using it, from my understanding. DYDX is now going away from Starkware and going to Cosmos, which I think is interesting. That news came out today. But if you expect more demand for, I guess, on-chain perpetual swaps, then you should expect DYDX and GMX to grow its share in terms of nominal value. And as an American citizen, I can't really leverage trade on centralized exchanges, or it's a permission system. So maybe there's going to be more demand to trade on decentralized exchanges like GMX and DYDX, as maybe there's less trust on centralized platforms like Coinbase, like Binance, like FTX, right? Something to keep in mind. I think I mentioned this at the beginning of the video. I don't even know how long this video is, but there's this new protocol controlled exchange upgrade coming to GMX called X4. To be frank, I don't fully understand this, and this is coming later in the year. So right now, it's just a simple spot exchange, leverage trading platform. But I think with X4, they're going to introduce PvP AMM, whatever that means, and also potentially synthetic assets, which could drive more demand to use the platform, right? And at the end of the day, GMX, it's still an unproven and speculative bet, right? Sure, the fundamentals look pretty decent, but at the current iteration of the product, it's probably not going to be like a slam dunk investment. But the bet is on the team to continue building via X4, via partnerships and integrations, and creating a better product over time. GMX and GLP Tokenomics have proven to be sustainable so far, and the platform continues to acquire, retain users with pretty decent volume and fees. But like I said, they have to keep innovating because the current volume isn't enough to justify the bull case. Risks. It is a leverage trading platform, but because the GLP providers are taking on the risk, they can't really list a bunch of long tail assets, because I buy GLP because I like being long Avalanche, Bitcoin, Ether, right? But if there's like a bunch of other shit coins that I don't want exposure to, then I'm not going to be a GLP provider. But if you're a trader, you might want to be able to trade long tail assets like, I don't know, Shiba or something. So there's that misalignment of incentives between GLP and traders, which could limit the amount of growth for GMX. Like I said, anonymous team with questionable runway. Hopefully the team can clarify how much money they have, and just an estimate of yes, we have 12 months of runway, 24 months of runway. Generally startups, you want 24 months of runway, but maybe the team can sell their own tokens, right? Which is totally fine. Competition. Not only are they competing with DYDX, they are also competing with centralized platforms. So there's that. Smart contract risk, very hard to quantify, but there's that. And what is the demand for a decentralized perpetual exchange? It's definitely there, right? It's definitely there, but I don't know how big that TAM is, right? Total addressable market. But at the end of the day, whether or not this product works, whether or not this protocol is around in 10 years, in the short term, it presents a really good farming opportunity. Today, they announced this week's rewards distribution. They collected $1.6 million in fees, and they're distributing it this much to GOP providers on Arbitrum and GOP providers on Avalanche, right? Pretty good. And if you're staking GMX, you earn this much, at least on Arbitrum. You also earn this on Avalanche as well. Okay, so in a bear, I think keeping track of protocols that's actually generating value, actually generating revenue, fees, is very, very important. And these are the protocols that are the most likely to survive in a bear market. No guarantees though, right? That is why I'm not betting too big. But if the fundamentals keep improving, if X4 is a game changer, then bam, I'll bet more, right? It's totally fine. Good farm. Exposure to GMX or not, GLP continues to crank out fees and has been a core part of my farming strategies in 2022, in the past and beyond. Okay, so Cool, that's the end of the video. I don't even know how long this video is, but if you've stuck around till the end, then congrats, you're in it for the tech, right? You're in it for the tech. Yeah, you're in it for the tech. One last thing I did want to go over are some of the data analytics and dashboards that are available too. So I took screenshots of this, right? This is the official stats.gmx.io page, and you kind of see, you know, like the volume, fees, etc. And one thing to note is that yes, the pink line represents AUM, and that's going down, right? Because the price of the crypto assets are going down. But if you look at the GLP supply, it's, you know, maintaining relatively flat. So this is a sign that yes, you know, people aren't entering, I guess, but people aren't leaving, right? Because GLP supply represents, because obviously if you leave GLP, then you're selling GLP, and if you enter GLP, you're minting GLP. Yeah, so you can look at the metrics there. And one thing to note, I took the screenshot earlier too, but the P&L of traders is already baked into the price of the GLP token so that there isn't additional volatility when people leave and enter. So if markets are going up and let's say open interest, you know, is very green, maybe you'd want to get out of GLP because you don't want traders to extract value from it. But that doesn't work that way because the P&L, trader P&L, is already baked into the price of GLP. That's something to keep into account. There's this website called gmxstats.com made by Crypto Messiah, and this is a new day, so you know only 2% of the day has happened because you know it's 30 minutes into the new day. But you can kind of see the volume, fees on both Arbitrum and Avalanche. You can look at useful links, financial reporting. You know, people like to use P ratios. I don't think P ratio is the correct way to analyze crypto assets. You know, because people buying sushi because of low PEs got wrecked. But who knows, maybe one day PE ratio does matter. And lastly, there's a website called DeFi Sims, and you can kind of do some simulations on, okay, like what if I, stake this much GMX, that much GLP at these APRs, like how much can I earn? And then hedging strategies, right? So the strategies that I've outlined. It's kind of hard to understand, but maybe you can play around with it and figure out what kind of strategy works best for you. So hopefully, through my slide deck and these dashboard resources, you can, make a decision for yourself whether it makes sense for you to farm on GLP or even think about, investing in GMX. And yeah, hopefully that was useful. If you want more daily updates, additional bonus videos, or I guess not bonus, but additional videos, then check out the private Discord. Link is in the description below. Thank you guys for watching. Have fun performing out there, and let me know what your thoughts are on GMX. Bye-bye.